Welcome back, best ever listeners, to the Horizon Podcast. I'm John Chang, and I've been active in real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, as I do every week, I must mention that I am doing this podcast independently, and what I say on this show does not reflect the opinions or positions of Marcus & Millichap. So, having said all that, I'm going to do something I've never done before. I'm going to rank different types of commercial real estate. I'm going to use that model with a kind of A, B, C, D, F, and then adding in S at the very top, right? So I've seen this on other YouTubes and other rankings. So I'm going to just follow that model. I've never done it before, so I don't know how long this is going to take. So I'm going to try to keep this in at about 30 minutes like normal. But over the last several weeks, I've been talking about inflation risks that are elevated, recession risks. The financing markets, the financial markets have been very volatile. There's, investments in stocks and bonds and other financial instruments are a little choppy and unreliable right now, making real estate, in my opinion, a better option. Consumer sentiment has been falling its way down. We have the tariffs out there and the risks they pose. The unemployment market seems to be holding up pretty well, actually, but there are risks ahead. We have risks of higher interest rates coming up. The cost of home ownership is really high and likely to go higher if interest rates go up. Cap rates are elevated about 150 basis points higher than they were just a few years ago in 2021 and 22. The pace of transactions, commercial real estate transactions, it has been edging higher, but it's still, little bit below average overall, lower than what we saw in kind of that average between 2014 and 2019. And I've also talked a little bit about the new tax bill that has passed through the House, but not the Senate yet, and how bonus depreciation could help investments over the first few years in particular. So, but like I said, I haven't tried really thinking about how I would rank different commercial real estate property types. I mean, in reality, it's always kind of finding the silver lining in any property type. And I'll do that to a degree as well. But I'm going to jump right in here and start in on this. I think I'm going to be pressed for time. So I'm going to start in with my F ranked property type. And I'll throw in some caveats. Right? I am looking at how these property types are facing short-term headwinds, but I'm also looking at how they perform over the longer term. I'm 5 to 7 years horizon. And so you have different factors coming into play. All of these forces I just mentioned, all the things with tariffs and inflation and risks of a recession. And then you also have to counterbalance the longer term drivers, what happens with demographics, what happens with behavior. So without further ado, the urban office comes in at the bottom of my ranking. And the reason is, and really I'm talking about older urban office buildings here. And essentially the vacancy rates on this property type is just really high. And, you get into, your urban office totality, you're pushing a 20% vacancy rate. And it's been elevated for these properties for a few years now, really since the pandemic. And so what it takes to revitalize an older urban office tower, and again, these are not the small office buildings. It's the large office buildings in the urban core, maybe built in the 1980s, that are the most problematic. And I think that they're going to face some headwinds. I should point out there are some urban office properties that are doing very well. The top tier, the newer ones, the ones that have great amenities, the ones that have been fully remodeled, they're actually doing really well. They are generating positive rent growth. They have very high occupancy levels. They're being sought out by tenants. because they are the best of the best in the places that people want to be. There are also a variety of markets around the country where the urban core is outperforming. Really a lot of smaller markets, even like some of the markets that have been less favorable over time, places like say Detroit, where the urban office vacancy rate is 12.3%. You look at it historically, and it used to be much higher than that. There are a few others, Columbia, South Carolina, doing pretty well. Cleveland doing pretty well overall compared to where it's been. Cincinnati, the current vacancy rate is lower than the first quarter of last year, is lower than the first quarter of 2019. So there are markets around the country where the urban office is outperforming. Charleston is another one. I want to mention the urban vacancy rate in Charleston is 6.2%. And that is exceptionally low, from a national standard. So I'm giving you a lot of exceptions to the rule, but there are a lot of markets where urban office is doing very poorly, facing vacancy rates into the 30% range. And so I think it's going to take quite a bit for urban office to get turned around, especially the older properties. And as a result, I'm putting them at the bottom of my ranking for investments. Now, as I say that, you can get some really good cap rates. And if you have an urban office strategy and the talents to operate those properties, this may be a fantastic opportunity to play the turnaround. But pretty much anybody else who's not an expert in office, I got caution flags all around this property type. Coming in with a grade of a D, I dropped in suburban office. Again, I think it's many of the same forces, although suburban office is really performing better than the urban counterpart, but it is facing still those behavioral headwinds. And I do think that those iron out over the next 5 years and things get better. I think I like suburban office, especially newer properties that are in a walkable location. Those are my, within the sector, probably my best bet. And whereas an old tired building in the suburbs may face continued headwinds over the long term, a lot will have to do with what happens to the unemployment rate. If the unemployment rate goes up higher, I think that there will be increased office demand as a byproduct, which is ironic. That's contrary to what we've seen in the past, but I think that a higher unemployment rate will bring more people back to the office who are working remote today. So suburban office, I'm putting in with a D. Again, there are pockets and cities where the suburban office is doing very well. I think of Miami and Las Vegas and Riverside, San Bernardino, markets where the suburban office has been holding up better than most parts of the country. And again, if you are an expert in office, I think that there are some fantastic opportunities out there today. But again, if you're an investor who has not been operating in the office sector, I would probably steer clear of these. Next up, I'm going to give these a C. C, kind of middle of the road, kind of the top of the bottom, if you will. And within the C category, I have two property types. The first is hotels. And the reason is because I think there are some hotels that are going to do just fine. I think limited service hotels in particular, especially in high demand areas where there's less competition, I think that they can do just fine. But there are headwinds. First of all, when you talk about Urban hotels, I think that they're going to face some headwinds. I think some of the popular destinations for leisure travel could face some headwinds. We're seeing a downturn in Canadian travelers to the U.S., as well as foreign travelers, international travelers from Europe or Asia. I think a lot of the political policies are playing into this, both in terms of tariffs as well as how we're handling students and student visas at American universities. I think that in general, we're creating a climate that is not as friendly to international travelers. And I think that our international travel to the United States is going to come down a little bit. If we go into a recession, that could also weigh on leisure travel as well as business travel. So that should weaken the demand for hotels. I think one of the other challenges is that the immigration policies are going to make finding the personnel to staff the hotels more difficult. I think that the wage growth for hotels employees are going to be going up as well because of that labor shortage. So hotels, I think, I guess I'm bundling them into a kind of a hit and miss model. Things, the hotels that cater to local domestic travel, specific drivable destinations could outperform. I think that the resort hotels may face a little bit more headwinds. And I think that the urban hotels also could face a slackening of demand, largely driven by the slowdown in international travel to the U.S. So, that's my C-rated hotels. The other C-rated property type is self-storage. Now, I know a lot of investors really like self-storage, and you know what? I think it's a fantastic property type, but we have been overdeveloping self-storage over the last few years. We had a great run, actually as a byproduct of the pandemic. The performance was exceptional, but we have overdeveloped a little bit. I think there's a lot of consolidation within the industry that makes it more challenging for an independent operator. I think that if you look at tertiary markets, small market self-storage, it could outperform. I think that that is still a durable business model. But I think if you're in the urban core, you're going to have to play ball with the REITs and the biggest operators. That's really how this is going to play out. And I think that oversupply risk is a problem. The other thing is that with the movement to kind of a teaser rate model for self-storage, followed by regular rate increases to the stabilized rate that takes a few months to get to, I think that it's becoming increasingly difficult for an independent operator. Now, if you flag with one of the large operators and have access to their management and their systems, I think you can still compete. But I think that a lot of markets are facing a little bit of a supply overhang, and the competition for tenants will remain pretty robust over the next few years. Now, construction is probably going to slow down. We've seen construction lending tightening up. We see the cost of materials and the cost of labor both increasing. So self-storage will work its way through this. I just don't think it's going to be a great property type, with isolated exceptions, right? If you are a self-storage expert and you're going down and getting your hands dirty and you're figuring out the market opportunity, I think there could still be some winners out there, but they're not going to be as easy to find as they were a few years ago. All right, moving up into my B category. I think I'll start in with manufactured housing here. Now, manufactured housing in and of itself has been a really popular investment option. It's done very well. It's done very well for some investors. But I think that first of all, there's a very limited number of properties out there. And I think a lot of the juice has been squeezed out of those, by, investors coming in, upgrading the properties or not, and raising the rates and making them, more, the rental lots more expensive. moving them to market, quite frankly. But it is not being well received by the tenants. And they're at risk of more public policy interference with manufactured housing, going forward. I see a lot more active policy, targeting that sector, over the last couple years. And I think it may get worse before it gets better. Now, granted, the federal policies on this are probably not going to be constrictive. They're not going to restrict these, but I think local policies is where you're going to see it show up. And so, I'd be careful of that. I would look at the local operational climate. I think if you're in in most of Texas or Arizona or states that have a more libertarian streak, I think that there's less risk of policy interference. However, I think if you're in a more liberal, tenant-friendly state, I think that the risks are higher. Now, developing new manufacturing facilities is relatively difficult. And really that's zoning and that's local ordinances and local challenges. So it is an insulated property type. I think it's going to get some tailwinds from the overall housing shortage. I think rental housing is going to outperform, generally speaking, throughout the next several years. But manufactured housing, not getting to an A, but still pretty good. It's a solid bet and it's a good option and opportunity. So my next B-rated property type is industrial properties in port cities or hub markets, intermodal hub markets, places like Chicago, Dallas, Atlanta, where you're transshipping products. Now, I think that this is going to get a little choppy, especially in West Coast regions, because of the tariffs and the reliance on imports from China. I think that that's going to create a bumpy ride over the short term in these port and hub markets. Port of LA, Port of Long Beach, I think to a degree Seattle, even Portland, maybe the Bay Area. I think that those port markets that are reliant on Chinese imports are going to face some choppy waters over the next however long it takes. I don't know. However long we're playing these tariff scenarios out. Phoenix also, Inland Empire, which are primary destinations for the freight coming off of those ships. Those markets are going to face the most challenges. Inland Empire, Phoenix have had a lot of development. So you already have a supply overhang, and then you throw in the choppiness of the trade situation. And I think that those, especially the big box industrial warehouses, are going to face a tougher outlook over the short term. But I think that it irons out over the longer term. I don't think that the short-term disruptions are going to totally destabilize the industrial property market, especially, even in these highly impacted metros, and that ultimately consumption will support the demand to fill the industrial space. So I think that there's a short-term headwind for industrial properties in ports and hub markets, but I think the long-term momentum will carry through. My last property in the Class B segment is multi-tenant retail. Now, I like multi-tenant retail. I think it's in a really good position right now. But again, I'm a little concerned about tariffs, and I think there's going to be some properties that have more risk. If it has a retailer that sells goods or products, not services, I think if that is the dominant mode for a retail center, maybe it's a power center, maybe it's a retail centric retail center, then I think it faces more risk because of the tariffs. If it is a necessity-based retailer, like a grocery anchored center where you have an optician and, a financial services company, maybe an urgent care clinic, a gym or athletic facilities, activity centric retailers that are experiential, those are going to probably do just fine. I think that those could actually do quite well. I think that your biggest challenge is going to be a department store type model where you have 30, 40, 50, 60% of the products being imported and being impacted by those tariffs. And again, I think over the long term, multi-tenant retail does well. I think that with the millennial generation moving into prime earning years and prime spending years, I think that especially the experiential retail centers, maybe they have, several restaurants, at the facility, at the location. Those properties, I think, could do very well over the long term. They're not going to build that much of it over the next few years. Again, I've gotten into this many times, but basically, cost of construction, ability to build are just not there right now. And we probably won't see much construction this year or next year. And it may drag on into 2027. We don't know yet. Part of it will depend on whether we hit a recession or not, what happens with inflation and so on. But I don't think that much retail is going to be constructed over the next few years. And that bolsters the case for multi-tenant retail. All right, now for my A property types. I'm going to jump in with local industrial properties, not the big bombers out in Phoenix or Atlanta or Dallas or Chicago. I'm talking about smaller industrial properties that serve a local metro. And so these may be in places like, say, a Salt Lake or St. Louis or, Cleveland or Cincy or, some of these other markets where you really have the industrial property is really there as a fulfillment center for the local metro. I think those are actually going to do quite well. You may also want to look a little bit at, say, cold storage, which could get a bump from the groceries. If we do go into a recession, people have a higher tendency to cook at home, eat out a little bit less. And should that happen, then those cold storage properties could fare a little bit better. So local industrial properties, they tend to have a lower vacancy rate. They're harder to build. They're more infill in locations. And I think those are one of the stronger options. Another A property, is single tenant retail. Now, the reason I like single tenant retail is it's generally a less risky property type. It has less management responsibilities. It doesn't qualify for the QBI tax advantages, the qualified business income tax advantages, and I think there's some other elements that don't qualify for single tenant retail properties. But if you have a high credit tenant and you have a good lease structure, ideally with rent escalations, you may not be able to get inflation based, but maybe even 1% or 2% rent increases. 3% is even better, of course. But those properties have opportunity there. I know there's a lot of single tenant retails out there that have no rent bumps built into them. They have flat leases over an extended period of time. I'm not as big a fan of those because I think that inflation can erode those values over time. But I think that there are many single tenant retail properties that could do very well for investors. And again, they don't require a lot of energy, time, or consideration. If you're coming out of a 1031 exchange and you want to move from an active investment property to a passive investment property without taking the tax hit on the gains, a single tenant retail deal could do very well for you. I think that the cap rates have come up a little bit. But this is not a property type where you want to use a lot of leverage either. So, single tenant retail, I think, plays through long term. You get what you buy, right? Just look at the lease terms and you can do the math. And, if it works, that's great. I would be cautious about retailers or tenants that may have recession risk or inflation risk, right? So if you look at the tenant and say, okay, if we have higher inflation, these guys could get in trouble. You might not want to go with that one. If you look at a retailer, single tenant retailer who's not a high quality, credit, they're a local, maybe a regional, maybe 1, 2, 3 locations, caution flags, right? It's going to trade at a higher cap rate. It's going to have better lease bumps and everything else. But will they be able to withstand a recession? That's probably my biggest question with that property, would be, what is the durability of the tenant? So some things to think about there. But overall, single tenant retail properties, I think, may be a good option considering the economic climate we are navigating into and through over the shorter term. And I think the longer term, it's a coupon clipper. So, it may or may not appreciate, but I think that it holds its value relatively well, depending on the length of the leases and the durability and credit of the tenant. My last property in the A's is apartments. And again, I know I put some warning signs out there. We did see consumer sentiment flatten out, but it's still very low. I think that that's a risk for apartment absorption looking forward. I think we could see a slowdown in household formation in the latter parts of 2025. If we do go into a recession, if we do have higher inflation and people start to get very concerned about their household budgets, I think that apartment demand could slacken some. But I think especially, say, Class B and Class C value add properties could have huge advantages under the new tax bill. I think the demand will be durable in general. People are putting off home purchases, and as interest rates go up and mortgage rates go up, I think that the demand for apartment rentals will continue to at least remain stable, if not improve. And then again, when I look at it over a 5-year horizon, I think that the momentum is still strong in 5 years, driven by demographics, driven by a slowdown in construction that we're seeing happen now. And I think that the sustainability of these properties is quite strong. So apartments are rounding out my properties with an A. Now, I don't know if you can guess what I'm going to pick as my S property. It's one nobody really talks about very much. Take a moment, think. What might this be? I'm going to give my top rating to medical office properties, especially medical office properties with heavy equipment. And by that, I mean like dialysis machines or x-ray machines, things like that, MRIs. These types of office properties, first of all, you can't just convert any old office into a medical office, right? They have different needs. They have different power. They have different water. They have different load strengths on the floors. So they're not exactly the same. In fact, the only thing they have really in common is the term office. And quite frankly, when I was at a healthcare conference, they were referencing them as medical outpatient buildings instead of medical office buildings. But The reason I have put this at the top of my list is twofold. One, they're very resistant to recessions. Two, you're more likely to have lease bumps in a medical office property than a single tenant retail building where you're working with a very high credit tenant. Third is they tend to have very long leases. 12 years is kind of the benchmark, maybe 10, going as much as 15. If you have one where they're backed by the doctors themselves, and again, look at the age of the doctors. If they're all 70 years old, then it's probably not as sturdy of a lease as if they're all in their 40s and 50s. So, look at the tenant, understand the tenant. But I think that medical office properties and medical office services are generally more durable than pretty much anything else during a downturn or in an inflationary climate or any given day-to-day climate of operation. But the other reason I put it into S is because of demographics. The baby boom generation is aging. They're pushing up into their 80s, their 70s. And I think over the next 5 to 10 years, I think that the momentum and the demand for medical office services you get at medical office facilities is going to continue to increase. We also have a shortage of doctors. So I think that this is going to continue to grow as our baby boom generation ages and requires more medical services. As people age, they go visit the doctor more and more frequently. Twice as much for somebody who's in their 60s as somebody in their 40s. Don't quote me on that. I'm reflecting on a slide I used several months ago. I don't remember the exact numbers, but essentially, as people age, they use office medical services much more frequently. I think what's happening with Medicaid and Medicare could be a challenge. So I would lean toward facilities that are not reliant on Medicaid and or Medicare tenants. But again, that aging population combined with the durability of services provided by the medical sector and the ultimate strength of the tenants in those properties and the low probability that they move at the end of their lease term, especially if they have heavy equipment in that office facility, all lend weight to the advantages of medical office properties. So there you go. I ran long, I'm pretty sure, looking at the clock here, 32 minutes here at this point. So I am running a little bit long. But I did manage to get through all of my rankings for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 different properties here. And let me know what you think. Shoot me a note on LinkedIn, John T. Chang on LinkedIn. If you want to shoot me a note, let me know if you think this is useful. Or if I should get back to my other business, mostly focused on the economics. But there you go. That's my ranking. So that is the horizon, right? As I mentioned earlier, these rankings reflect how I think these properties are going to do over the long and short term. But ultimately, I think the long term matters more to investors because you have to look at your exit strategy. So there you go. Thank you, best ever listeners, for joining me. I just love that you're listening in on the Horizon podcast. And of course, I will be back here next Sunday and every Sunday with real estate insights to help you understand what's really going on in commercial real estate. So I'll see you all next week. And as always, keep your eyes on the horizon.